Now let's cross the pond back to North America and talk about arguably the most important central bank out there. Given the importance of the US dollar as a reserve currency, the magnitude of the US economy, and the impact on US rates on the world, it's no surprise that the Federal Reserve is keenly watched by all market participants. Their monetary policy not only shapes their domestic market, but also shapes the global economy. The trickle-down effects of their policies impact how U.S. banks interact with borrowers and savers, and during the last global financial crisis in 2008 under Ben Bernanke, it can be argued that their coordination with other global central banks and the policies that arose saved the world economy from a far worse fate. But as for the Federal Reserve itself, less people are aware of the structure of the bank. As shown here, the Federal Reserve System is made up of 12 regional Federal Reserve banks, named after the locations of their headquarters, and they're the operating arms of the central bank. Under the original Federal Reserve Act, all U.S. national banks must be a member of one of the 12 regional Federal Reserve banks and subscribe to 3% of their own capital as stock in the respective Federal Reserve Bank. State banks may join if they meet certain criteria. And regardless of whether a financial institution is a member or not, all of the roughly 20,000 depository institutions in the U.S. are subject to the Fed's regulations, including reserve requirements. This archaic stock ownership requirement still remains today amongst the 3,000 American commercial banks that are members, and have led to ambiguity and conspiracies about the Fed's independence and legal status. These stocks pay a small dividend out of the Federal Reserve's bank's earnings, but are otherwise very different from normal common stock. They do not have voting status. They cannot be freely bought or sold, nor borrowed against. The member banks do not get to decide on the directors of the Federal Reserve banks and have no ownership on the surplus or assets of the Federal Reserve banks. So these shares are strictly symbolic. The main governing body of the Fed is known as the Board of Governors, and that's led by the chair and the vice chair. In addition to that, there are 7 governors who also sit on the Fed's Open Market Committee, known as the FOMC. We'll take a look at these 2 important groups next. First, let's look at the Federal Reserve Board of Governors. This board is comprised of 7 members or governors who are nominated by the President and confirmed in their position by the U.S. Senate. The market pays attention to speeches by all governors, as well as the voting members of the Federal Open Market Committee and non-voting Federal Reserve Bank presidents in order to get a read on the future direction of the Fed. Key events to pay extra attention to are the chair of the Federal Reserve's semi-annual monetary policy report to Congress, which is known as the Humphrey-Hawkins report, as well as the annual speech at the Jackson Hole Fed Symposium, also by the chair. Now let's look at arguably the most famous part of the Fed Open Market Committee, or the FOMC for short. The FOMC decides on the policy rates of the U.S. Central Bank, hence their importance. 12 voting members of the FOMC consist of the 7 members of the Board of Governors of the Federal Reserve System. The President of the Federal Reserve Board of New York always serves on the Open Market Committee, and 4 of the remaining 11 Reserve Bank presidents take turns on a rotating 1-year term serving on the FOMC. They meet 8 times a year, roughly every 6 weeks, to decide on the committee's target for the Fed funds rate and other policy rates. A 2-day meeting results in a vote. The vote may not be unanimous, but majority rules and dissenters are noted in the FOMC statement. After all meetings, market watchers pore over the FOMC statements to find any carefully worded changes and interpret the tone of the statement. We'll have an exercise later so that you can try also to interpret the tone of an FOMC statement. After its introduction in 2011, the FOMC releases a dot plot after certain meetings. The dot plot anonymously tracks all of the 19 voting and non-voting members' expectations for the range of future interest rates in subsequent years and in the long run. Given that the FOMC advertises itself as being data dependent, the dots and the changes from each release to the next gives us the expected direction of rate movements, whether they are looser or tighter. At 2 p.m. Eastern Time on the second day of the FOMC releases all of their policy rates, which we'll discuss next. On to Japan next. The Bank of Japan, as the central bank of Japan, decides and implements monetary policy with the aim of maintaining price stability as to achieve inflation of 2%. However, due to a magnitude of reasons such as demographics, asset bubbles, and overly aggressive bank lending in the 80s, the country has undergone economic stagflation and resulted in what economists have dubbed as the lost decade between 1991 and 2000. However, the economic malaise has dragged on into this century, and it's now almost 3 decades of low growth, low inflation, and increasing bad bank debt. Nonetheless, the Bank of Japan has been quite innovative and tried many different measures such as QE, quantitative easing in 2001, which is known also as large-scale asset purchases. The central bank has tried to do this in order to pump liquidity into the banks. We'll go further into the mechanics of QE on the next slide. They also brought in QQE, which is quantitative and qualitative monetary easing, in 2013, and QQE2 in 2014. This policy is meant to expand the monetary base by further increasing bond and other securities purchasing by the central bank, as well as increasing duration of the assets that they've bought. In 2016, after QQE and QQE2 did not have the intended effect, the Bank of Japan introduced negative interest rates in order to force banks from placing their deposits with the BOJ and compel them to lend it into the banking system to stimulate growth and inflation. And most recently, in 2018, the Bank of Japan introduced YCC, known as yield curve control, and we'll explain that in more detail a couple of slides along. So now let's look at the structure of the people who have come up with these innovative policy decisions, the Bank of Japan. Policy is decided by the policy board at monetary policy meetings. They meet 8 times a year, and these are 2-day affairs. The policy decisions that are made by a majority vote of the 9 members of the policy board, which consists of the governor, the 2 deputy governors, and 6 other members. The policy decisions do not come out at a set time, but are generally released at the second day of the monetary policy board meetings. So as we mentioned earlier, the inflation in Japan still remains stubbornly low and growth has been underwhelming. As the BOJ continues to grapple with this dilemma, the policy rate isn't really that useful or relevant, as their present concern is the long-term interest rate. Hence, they continue to pursue QQE with yield curve control to achieve the elusive goal of 2% inflation.